Good morning. My name is Greg Upton. I'm Associate Research Professor here at the LSU Center for Energy Studies. Welcome to our 2022 Gulf Coast Energy Outlook Kickoff. We especially welcome those of you who might not be familiar with the Center for Energy Studies, or CES as we call it. CES is a unique research unit at LSU, and that we were created by the legislature in 1982. We're mandated to provide energy information and analysis that responds to the needs of the legislature, public agencies, business and civic groups, as well as the general public. The annual Gulf Coast Energy Outlook is one way that we fulfill this mission. The majority of our funding comes from the legislature through LSU, and we also participate in funded research through federal and state agencies, as well as private companies. We pride ourselves in our diverse constituency and funding sources, which allow us to provide analysis without a political or economic agenda. We especially thank the sponsors of this year's Outlook from across the energy value chain, including at the platinum level, we have the Louisiana Mid-Continent Oil and Gas Association and Phillips 66. At the silver level, we have Entergy, Enverus, Koch, the Louisiana Chemical Association, and the Louisiana Oil and Gas Association. At the bronze level, we have the Southwestern Electric Power Company, the Louisiana Department of Natural Resources, and the TJC Group. And at the contributor level, we have Fugro, Log, and LOX. So please provide your support for these organizations who contribute to the Louisiana and Gulf Coast economy. And if your organization is not on the list, please consider becoming a sponsor for next year's Outlook. I'd also like to personally thank the dozens of individuals from industry, government, trade organizations, and academics that spent their valuable time speaking with me and David over the summer and into the fall in preparation for this year's Outlook. While crunching the numbers and the modeling is very important, equally as important is the input from stakeholders. So it simply wouldn't be possible without you. So thank you so much. A very brief agenda for today. I'm going to start off with discussing the uncertainties and modeling assumptions that we're going to use in our Outlook, and it's really going to drive all the analysis. I'm going to then move through the different parts of the value chain. And so we have a whole lot of slides today that we've provided on the chat feature here. So some of them we'll go through quickly, but we wanted to provide that and we'll be able to discuss at the end as well. Then we're going to switch over to our executive director, Dr. David Dismukes, who will discuss the electricity sector, industrial developments, as well as energy exports. Then we'll switch back over to me to present the employment forecast, and then back over to David for the concluding remarks. If you have any questions, as I mentioned, please type them in the Q&A on Zoom, and we'll do our very best to leave time at the end for answers. As you consider asking questions, please do keep in mind that the webinar will be recorded and posted online. The Outlook itself is now on the center's website and has been put in the chat feature here on Zoom, so please take a look. So just a housekeeping, when we refer to the Gulf Coast region, specifically, we're going to refer to the states of Texas, Louisiana, Mississippi, and Alabama. And of course, in terms of oil and gas production, the Gulf of Mexico itself, unless stated otherwise. And sometimes it will be a PAD district, for instance. This is going to be the outline for today's discussion. And we're going to start off with the introduction and these uncertainties. So there are really 5 big uncertainties that we discuss at the beginning of the Outlook. And so we're going to go through each one of these and sort of talk briefly about how we're thinking about these, what the baseline assumption is when we move into the more specific modeling efforts. So the first, of course, is the recovery from COVID-19. And so the worst month in terms of US employment was April of 2020, where we were down 14.7% below the pre-pandemic peak. And so you can see that just really a big drop there right whenever COVID hit in March, when everything shut down. The good news is that we're recovering. We're not back to the pre-pandemic peak yet, but you can see August, September, and October, we've sort of, continued to creep back closely towards it. I'll note that these numbers are actually updated from what's in the actual Outlook as a jobs report came out a few days after we sent it off for formatting. This shows you that employment indexed to pre-pandemic alongside gasoline sales, diesel sales, electricity sales, and jet fuel sales. And I want to highlight 2 important things here. First, you can see that diesel and jet fuel sales on average over the last decade have grown a little bit faster than employment. So they've grown faster than economic activity more generally. But when you look at gasoline sales and electricity sales, they were really flat. There really wasn't any growth in the US economy for gasoline and electricity sales. And then of course you see COVID there, and then you see all of those with the notable exception of electricity was impacted. And by the way, these are seasonally adjusted numbers here for energy demand. So let's zoom in to this pre-pandemic to the pandemic time period, and you can see how each one of these was impacted. So you can see electricity was impacted a little bit, but it's really back to normal. You can see gasoline and diesel, of course, were impacted, but have come back with economic activity. The real outlier here is jet fuel, that we're still about 20% below the pre-COVID level. And so the sort of conclusion here is that, yes, we're coming back. Energy demand is coming back with economic activity. But as David's going to highlight further, really where we see that growth coming from and where we see the investment spurred here in the Gulf Coast region is really going to be export oriented. And so this year modeling assumption will assume that COVID continues to attenuate globally and the world slowly returns to normalcy over about the next year. And again, we anticipate that the long run energy demand growth will lead to increases in US energy exports, especially to the growing developing world, which will show that exports are at an all-time high right now. That's not because of that domestic consumption, okay? The second big uncertainty to think about is decarbonization. So when we were conducting our phone calls this year, there was perhaps no topic more on the minds of the people that we were talking with. And so, people from across the industry are increasingly trying to understand not only the risks associated with decarbonization, but also the opportunities. And as will be highlighted in the energy manufacturing activity, we're really starting to see announcements for investments in low, zero, or even negative carbon energy and chemicals, which could provide a big actual opportunity for investment here in our region. So a few sort of stylized facts when we think about the Paris Agreement that went into effect in November of 2016. Of course, the US exited that agreement with President Trump and has re-entered the agreement with President Biden. But it includes 190 countries representing over 97% of global emissions. We compare that with Kyoto from just 2 decades prior, and that only included 14% of global emissions. And so you can really see the increase in sort of the attention on this topic globally. We've also seen all of these companies making these environmental and social governance goals, in particular having very specific decarbonization targets. And we're starting to see these companies really thinking about their entire value chain and what is their carbon intensity. And a lot of the motivation for that is, for instance, the EU, and this is just one example, is considering these carbon border adjustment mechanisms, where we say, okay, if we're going to implement a carbon tax in different jurisdictions, we don't want to just export those carbon emissions to another part of the world. And so perhaps in the future, Gulf Coast companies may pay a carbon tax when it exports products, regardless of this domestic policy. And so again, this is a risk for us, but also an opportunity and something that companies are increasingly paying attention to. So how does all this shake out? So although decarbonization may lead to near-term challenges for Gulf Coast industrial expansion, it also can create opportunities. And so industrial decarbonization has the opportunity to create a competitive advantage for the Gulf Coast industries if done successfully and cost competitively. And I think that this is really the key. And over the forecast horizon, we actually see decarbonization creating considerable opportunities for continued regional capital investment. And a number of those capital investment that David's going to discuss are actually really motivated by this decarbonization. Uncertainty 3, of course, is what does the new Biden administration mean for the energy industry, and in particular with offshore drilling. So you might recall in last year's outlook, on the campaign trail, we had discussed President Biden said he was going to, quote, ban new oil and gas permitting. And when we released last year's outlook, it was actually after the election, but before we knew who was going to who won the election. And so we had talked to some legal experts last year that told us, it would be very difficult for the administration after a lease has been sold to not give permits for activity on an existing lease. And so in January, whenever President Biden's executive order came out, we can see a little bit of nuance in that language change. And it says he's going to pause new oil and gas Leases really dropped the use of that term permanent there, while a, quote, comprehensive review and reconsideration of leasing practices goes underway. So in March, the lease sale was canceled because of this. In June, a preliminary injunction was granted in federal court that stated that the BLM and BOEM must continue the leases while this review is complete. And actually right now, just an hour ago, a Gulf of Mexico lease sale is being conducted as we speak because of this preliminary injunction. So we are still waiting for this comprehensive review that has not yet been released. So again, how do we think about this in the outlook? Well, for modeling purposes, we're going to assume that offshore activity is going to be continued in the short term, at least over this forecast horizon. And as we've done in prior years, sort of our policy is we don't take into account policy changes, proposed policy changes, until they're actually enacted. And so that's what we're watching right now. But this is going to, I think, be a really big thing to look at for our region. Another thing that we alluded to in the outlook, but was not released when we sent off for formatting. So we always joke that no energy news can happen from the time we send the outlook off for formatting until when we present it. But unfortunately, the federal government and industry doesn't listen to us. But the EPA new methane rule was just released, and it was released on November the 2nd. So here's some highlights here I pulled from the Methane Emissions Technology Alliance, had a webinar with Bob Kleinberg, who was at Schlumberger for 38 years, moved up the ranks there, and now is an academic researcher at Columbia University. And this is sort of his highlights of it. So there's 700,000 new well sites that are subject to EPA regulations. Flares and other control devices must achieve 95% reductions in methane. While prior rules required that there be flaring equipment, but there wasn't some efficiency requirement. It also changes the type of detection methods that are acceptable. So now allows for aircraft-based surveys. They have way higher detection thresholds, but you can cover more land. And it also there are also some new regulations from PHMSA that there's 400,000 miles of gas gathering pipelines that are also now under federal oversight. So this is EPA still accepting comments for this rule over the next 60 days. If you're part of the industry, it's definitely something to look into. But again, it's something that we're not making any assumptions about the effect of this on upstream activity into the future. Okay. Uncertainty 4, and this was something I was personally curious when talking with stakeholders is, we've had 2 rough years of hurricane seasons, and how has this impacted the outlook for investment here in the Gulf Coast region? Are we seeing that there's just too much risk from hurricanes and storms, and therefore this might make people cautious to make investments? And so Hurricane Ida hit Port Fourchon, of course, in August at a Category 4. Over 1 million customers without power, 9 refineries shut down, accounting for 14% of U.S. refining capacity. Over 90% of Gulf of Mexico production was halted. And Phillips 66 Alliance refinery sustained damage and is now announcing it will be converted to a terminal facility, which again, actually the announcement came after the outlook went out. And so, this is one of the questions we've asked. And the GCO, we're going to assume that the majority of effects from the 2020 and 2021 hurricanes relative to the energy sector are short-lived and have not materially affected companies' decisions to make regional energy infrastructure investments. And this is something that we've heard consistently from companies as, look, when we're making a new investment, we understand these risks, we understand how to mitigate those, and they're kind of baked into the cake. So that's some silver lining there with hurricanes. And the 5th big uncertainty is the China trade negotiations. Last year in our outlook, this was really one of the big things that we highlighted. You might recall in January of 2020, the US and China signed phase 1 of a trade deal that went into effect February of 2020. And whenever we talked to the political types, what they told us is that both the Trump administration and the Xi administration really wanted to sort of kick this can down the road past the US election that happened last November. And so they kind of agreed to some very specific import targets, and they had this 91-page phase 1 agreement with the anticipation that if President Trump won the election, they would go and negotiate a sort of longer term phase 2. What's important to note is that China is not on track to meet these import targets. which creates a little bit of a challenge for the Biden administration. How does he deal with this? Does he hold their feet to the fire, so to speak, with the Trump administration policy? Or does he say, look, that was a prior administration, let's kind of start over here? And so in October, the Biden administration began unveiling its China trade policy, and this is this October, October 21, following a review of import tariffs and other Trump administration policies. And perhaps surprisingly to some, Biden has pretty much decided to continue these Trump-era tariffs while launching new trade talks with Beijing. So there really hasn't been a notable change in policy here. And so it's really not clear whether President Biden is negotiating phase two or the extent to which he intends to hold China's feet to the fire, so to speak, on meeting these commitments. You might have seen in the news last week that President Trump and President President Biden and President Xi had a virtual meeting to discuss these issues. And so we're going to, again, assume that trade talks with China do not deteriorate and new tariffs are not implemented. But again, this is a fluid situation and one that can really impact the export-oriented nature of our industries here on the Gulf Coast. All right, so now we're going to get into the different parts of the value chain. Please keep in mind, we have lots of slides here. I'm going to go through some of them sort of high level, but all of them have been provided for you on the link that we provided. So let's start with upstream activity. So of course, we've had this decade-long trend of growth in oil and natural gas production that's been facilitated by technological advancements in horizontal drilling and hydraulic fracturing. And you can see the effect of COVID there has led to reductions in both oil and natural gas production nationally. When you look internationally, what you saw is that the share of oil production from the U.S. had been climbing again for the past decade or so, that sort of upward trend, but has really been stopped by this COVID pandemic. And so yes, U.S. and global production is down, but that sort of gain of the share within the U.S. has also been slowed here from the pandemic. This shows you Gulf Coast production, which again has also been down for both oil and natural gas. So what's the crux of this? Whenever we look at the US and Gulf Coast production for both oil and natural gas, what we do is we compare the 2019 monthly production numbers from the 2021 monthly production numbers, and we're looking at the percent difference to sort of see pre-pandemic, post-pandemic on an apples to apples basis. And what you see is that in the US and Gulf Coast region, oil production is still below pre-pandemic levels, while natural gas production, on the other hand, has exceeded these pre-pandemic levels. And so this is going to be important to think about, again, when we're thinking about the health of the refining industry, LNG exports, and other export-oriented industries here. So when you look at the rig count, so as everyone knows, the price here is climbing up. Rig count has started to climb up as well, but really not at the steepness of that price increase. When you look at the US rig count right here, and if you sort of squint your eyes and ignore the vertical axis there, and then I switch to the Gulf Coast rig count, they really look very similar. Now I'm going to switch to the Texas rig count. And again, if you kind of squint your eyes and ignore the vertical axis, again, these three look very similar. But then when we switch to Louisiana, you see this very different trend, and you see this kind of longer term declining trend in the Louisiana rig count. And this, unfortunately, is something that we don't see really being reversed here into the future. And so notably, Louisiana rig count has become decoupled from the national Gulf Coast and Texas rig counts. And this is going to be something that we explicitly take into our account when we're doing our employment forecasts of these sectors. The Permian Basin has really been where a lot of the action has been, both where a lot of the rig count reductions were during the pandemic, but also where a lot of the growth has been. And so in terms of thinking about that kind of swing producer, the Permian Basin is where a lot of our attention goes to. Haynesville, despite the rig count in Louisiana being low, has really been doing exceedingly well. We're seeing record increases, records of natural gas production from the Haynesville. And also, we really believe that this is very much facilitated by that LNG export that we're going to talk about here in more detail a little later. We look at historical inflation-adjusted crude oil prices. And so in the 90s, you had relatively low prices and relatively little volatility. Then in the 2000s, you had high volatility and high prices. And then now that shale production has come online, we're back in this kind of lower volatility and lower price time period. Despite this run up recently in the price, which we sort of view as a mismatch between demand coming back at a different rate as that supply coming back, we really believe that we're still in sort of this third epoch, if you will, of relatively low prices into the future. And this is confirmed by futures markets that are currently in backwardation. And so the futures markets are predicting that it's going to converge to about the $57 per barrel mark. You look at natural gas prices, you see a very similar trend. You see low price, low volatility, high price, high volatility, and then in the most recent epoch, low price, low volatility. You can see Winter Storm Uri there, which again, David will talk about in more detail later, and also this recent price run up. But again, futures markets are kind of thinking that this is a little bit of a temporary as we recover from COVID. And, what rate does supply and demand come back together? And so futures markets are in backwardation and believe that prices will converge to the $3 to $350 per MCF range. And this is our broadcast model that shows the production forecast into the future in both the Gulf Coast, the US, and then the rest of the United States, as well as that share. So what I like to do with these is really look at, the forecast itself is interesting. And this comes from the Enverus broadcast model. So they look at all the different formations across the country. They look at break-even prices. And then they estimate those break-even prices, and then they merge that with futures markets to get a production forecast into the future. And what I really like to look at is how that forecast has changed. And so as you can see, 2 years ago, Prodcast was forecasting that we were going to be to almost 16 million barrels a day of oil production by 2030. Last year with COVID, which of course no one predicted, that was really forecasted dramatically, was adjusted down to sort of think that we're going to have flat oil production. But interestingly, the production has exceeded those forecasts and is now projected to again grow over the next 5 to 6 years, not quite to get to 16 million barrels a day, but more like 14 million barrels a day by 2030. And so production, and this is something to think about when we do the employment forecast later, is anticipated to increase over the next several years. And then when you look at the oil production from the Gulf Coast, again, you see a very similar trend here. Now let's look at natural gas production. Again, we're going to forecast an increase in natural gas production here in the US, as well as in the Gulf Coast. And again, let's look at the sort of historical comparison. So again, we were forecasting growth 2 years ago. Last year, because of the pandemic, we had sort of flat natural gas production. But again, natural gas production really didn't do that at all. It's actually increased, as we talked about earlier. And now we're again re-projecting growth here. And so there's a lot of gas resource out there. And we see a similar trend here for the Gulf Coast region. So when we put all that together, this is the value of oil and natural gas production, which is the production of oil, the production of gas times the relative prices. And this gives us as our value of production forecast. And so what's notable here, we're sort of at an all-time high here. We're projecting that value is gonna be high into the future when you merge all this together. And this is gonna be one of the inputs to our employment forecast a little later. So I'm gonna very quickly talk about midstream constraints. There's two graphs that we look at kind of year to year. The first is we want to see if there's any constraints with oil shipping. And so we look at two things. Number one, we look at the share of oil that's being shipped from the mid-continent down to the Gulf Coast via tanker and rail. And this really represents sparse pipeline capacity. And if there's sparse pipeline capacity, well, that's going to give the economic incentive to do more oil pipelines. And on the bottom here, you see the West Texas Intermediate LLS Louisiana Light Sweet Premium. And so you can see that oil is really kind of an equilibrium here spatially across the country. And this perhaps isn't surprising given that oil production still hasn't reached those pre-pandemic peaks here. And so this doesn't really say that there's going to be this says that there's probably not going to be a lot of investment in oil pipelines over the next few years. But for gas, we actually see a different story. So on the top here, we see flaring in the Permian Basin. And you can look at the three different subbasins there, the Central, Midland, and Delaware. And on the bottom, we see the difference between Henry Hub and Waha. And so, of course, Waha is the natural gas hub in the Permian Basin. Henry Hub's here in Louisiana. So as you can see over the last few years, we've seen that premium for Henry Hub has been reduced, but we're still flaring about 150,000 cubic feet a day of natural gas. And so as a result, what you're seeing is about 40 BCF of new capacity potential out there that is in the market. And these are potential projects that are listed by EIA. So we think we'll continue to see some of these natural gas projects move forward over the next few years. So now we're going to switch over to the power sector, and I'll let David take the reins here.
Sorry, I was on mute. Okay, let's talk some about the power sector and some of the trends that we're seeing there. Oh, sorry about that. So in terms of sales, Greg talked earlier about epochs and various different time periods. You've got two that are pretty strong that show up in the historic sales numbers and show and underline some differences between U.S. electricity sales and those along the Gulf Coast. A lot of growth growing throughout most of the 1990s and the early part of the last decade as we moved into this, what I'll call first phase of electrification. Everybody was moving to a lot more digital types of equipment in the households, variable speed motors on your HVAC systems, big television sets. This was also a time period with pretty good, strong economic growth. And so the average size of houses were getting bigger. People were having multiple electrical appliances in their house. So we had relatively strong growth during that time period. But as most of you know, natural gas drives a lot of the underlying wholesale prices and generation costs for electricity. And as those start getting into rates in the middle part of the last decade during the natural gas crisis, we started to see a slowdown in combination of not only just attrition, but a lot of utilities around the United States and legislatures forcing and requiring energy efficiency standards. So since that time period, in the last recession in particular, you've seen relatively flat growth. Whereas for us along the Gulf Coast, we were relatively flat throughout the 2000 period, not really reflective of kind of what you saw in the larger scheme, primarily due to how those high natural gas prices impacted us more proportionately here, given our high gas generation and the fact that industry was cutting back. You see this kind of growth going up in electricity sales, in part due to the growth of industrial activity and just our increasing relative share to the U.S. averages. And again, this drives it home pretty clearly. You look at those shares of industrial sales that have historically hovered around 18 or so percent. We're now in excess of about 22%. And again, we anticipate those to grow, maybe not as fast as we've seen in the past, but will continue to grow as we move into the future with a continued industrial expansion. As Greg talked about earlier, a big theme with industry and in the power sector has been carbon emissions. We've made a lot of improvement both nationally and along the Gulf Coast in terms of emissions per megawatt hour. For those of you that aren't familiar, the center just recently, about 2 weeks ago, I believe, published our greenhouse gas inventory. We've got one of the appendices to the report has a lot of detailed information on important changes that we've seen in Louisiana in particular, not necessarily the total Gulf Coast. But again, a lot of these have been driven by thermal efficiencies at utilities as well as fuel switching. And you can see the U.S. and the Gulf Coast keeping par. With the U.S., a lot of those numbers are due to considerable fuel switching, particularly moving out of coal. We don't have as much coal here, and a lot of the movements we've seen along the Gulf Coast have to do with continued thermal efficiencies in the natural gas generation that we have. Our share of CO2 emissions are, however, a little bit up. Primarily because the trends you see in the U.S. average, where they're moving away from coal and into gas, were relatively constant to down. But that percent decrease overall for the United States, particularly with the phasing out and retiring of coal assets in particular, is kind of shifting those relative numbers. In terms of the criteria pollutants for acid rain, those have come down as well, kind of the positive byproducts of these thermal efficiencies that we talked about before, as well as on the nitrous oxide emissions for the U.S. as well as for the Gulf Coast. But the big story, as I'm sure most people are aware by picking up the paper and looking at it both locally and nationally, is this changing composition that we have in our generation fleet in the United States and the continued modification and changes we're going to see on a forward-going basis. You can see as we go out into the future, increasing shares being dedicated to both wind and solar on a percentage basis. Solar is obviously going to be much more, as well as on a level basis. Solar is starting to pick up now with wind. We saw a lot of early growth with wind in the last decade. Solar now is starting to pick up. The other big takeaway in all of this is just the continued retirement of coal facilities. We've had about as much as 48 or so gigawatts already retired. We're looking at another 23 from a US perspective overall. And the same kind of trends, I mean, like Greg said before, you just kind of squint your eyes and you kind of don't pay attention to the kind of the level differences. The trends are some of the same that you see here along the Gulf Coast. Considerable amounts of solar in particular relative to the US average, particularly in this region. Not as much on the wind side, but certainly a lot on the solar side, and a pretty significant reduction in reliance on coal generation and some pickup here in natural gas. In order to interconnect a generating resource into the high voltage grid, you have to get in line and you have to have a bunch of system studies that are done. Our regional transmission organization in this area kind of keeps a tally and a list of those companies that have made those requests. And this will give you an idea of who's in line and the capacity amounts that are out there right now in the MISO South region alone. And there are considerable amounts that are dedicated primarily to solar, not only in Louisiana, but in the MISO South region in particular. If you just look at the queue for Louisiana alone, just over the next couple of years, we're looking at somewhere around 10,000 megawatts of new capacity. And if you look at the forecast for MISO South that MISO itself has done, where it handicaps essentially, some of these announcements, projects on paper are just that, how many are actually going to be developed and what are they planning on? It's about half of that amount, somewhere around half of that total amount. I think somewhere around 5,000 megawatts here in the South region alone, as opposed to the 10 that are in the queue. So quite a bit out there, and certainly something to watch for as we move into the future. The other big event that impacted both natural gas markets as well as power markets is this last winter storm Uri. So as you look through some of these slides that we'll talk about a little bit later, and particularly with regards to refinery operations, chemical operations, you can see three distinct kind of discontinuities that arise in those trends. With the two hurricanes, Laura and Ida, that we talked about earlier, that Greg went into detail about, and then this winter storm as well. Record peak demands in most of the control areas in the regional transmission organization areas, MISO, SPP, and in ERCOT. A lot of disruptions and interruptions and people without power. Certainly a very catastrophic event and unheard of type of event that I think will change a lot of thinking when it comes to utility planning on a forward-going basis. And I think one of the things to keep an eye out for as we move forward are going to be the increasing needs to and requests to kind of double down on resiliency investments to prevent these kinds of outages, or at least the severity of these outages on a forward-going basis. So let's switch gears a little bit, talk about energy exports. One of the areas that has led the Gulf Coast from an energy export perspective has been our refined product sector. PAD 3, the area down here along the Gulf Coast that is defined by the Department of Energy, has the largest amount of capacity of any region in the United States at close to 10 million barrels a day of refining capacity, followed only by a distant second with the upper Midwest and PAD 2. As you can see, these are the annual trends in utilization and capacity. We're starting to see some decreases in operating capacity, and I think everybody's familiar from the paper of the shutdowns at both Convent, as well as the most recent announcements for the Alliance refinery. Utilizations were down significantly because of COVID in 2020. You start looking at the monthly data. So this is your annual trends. You look at the monthly data, you can see distinctly how those operating utilization rates fell with the shutdown and the lack of need for refined products, jet fuel, gasoline, just go down the list on how those utilization levels fell throughout that time period. Gulf Coast, not quite as bad as the US average overall, not too much to be surprised about given the increased relative efficiencies of most of the Gulf Coast facilities. You see this kind of dip down here, again, because of that winter storm Uri and some of the tropical activity in the summertime, and some recovery that we've seen over the last year or so since that time period. In terms of product supply, this is, again, we're going to kind of go back and forth between the annuals and the monthly data. You can see the dips here associated with COVID, particularly the big change that Greg talked about earlier with jet fuel. And again, you see those month to months, and you see how bad a lot of those production levels got as we moved through most of 2020 during that pandemic year. Some recovery, but still back down considerably relative to where we were in 2019. We still are, though, a net exporter with regards to refined product. That has taken a little bit of a hit as a consequence of the pandemic, but we still continue to see some recovery there and continued strong net growth, even though it's a little bit down from 2019 levels. Crude oil exports is another big story that we started to talk about in the last two GCEOs with the release of the crude oil embargo in 2015. We've seen those numbers and the investments in this area increase pretty considerably. A lot of the exports of crude from the United States leave the Gulf Coast area between Corpus, Loop here, as well as some from Houston. You can see those numbers increasing to well over 3 million barrels before the pandemic. They are down, and some of our net imports have actually increased a little bit as a consequence of that change and the decrease in those exports, which in part are driven by changes in production that Greg talked about earlier. But the refined product side of this has continued to be pretty strong and robust, and continues to be optimistic. LNG has been another area where we've seen really a big surge in the post-pandemic area. And one of the reasons why we're seeing changes in prices right now is the concern about a lot of gas leaving US markets and going to Asia and Europe, where they're having a variety of different energy challenges that include low stocks of alternative energy resources like coal, or poor years on renewable generation like hydro and renewables that you've seen in Europe. So those are all big challenges, but you can see those numbers. Most of our LNG facilities now that are operational are at their full capacity levels in terms of their exports. And you can see that in the chart as we move through 2021. A lot of this is going to Asia. If you collectively look at oil and gas exports, you can see how they've changed over the last couple of years in this big surge that we had in the aftermath of the pandemic. This is Gulf Coast exports to China. This is Gulf Coast exports to the rest of the world, and those are picking up as well, building in part mostly on those Asian exports, but also to a lesser extent those moving into Europe as well. One of the big challenges for energy prices as we move through the rest of this year and the next year is going to be what's the outlook, what's the demand. A lot of that's going to be driven by expectations about the global economy. I think we're starting to see some slowdowns on that. There are some analysts that would expect or anticipate that we may have already or are closely getting to peak refined product demand. And those are going to be things that I think influence in that reversion to mean that Greg talked about earlier with prices. I think that's in part driving some of those numbers and some of those changes that you see. In terms of the outlook for crude, you can see that those have been positive, revised upwards. In the current annual energy outlook for the Department of Energy relative to where we were last year, well in excess of 3 million barrels a day. So that continues to be a strong growth opportunity for the Gulf Coast, as well as our current increases in LNG exports. Let's switch gears, and lastly, I'll wrap up my part of the discussion here on energy manufacturing activity. This has been, just an amazing area for the Gulf Coast, and particularly for Louisiana over the last decade. In total, just across this entire time period, you're looking at well over $300 billion in investment, which is, I don't know that you could probably find a historic time period where you've had so much investment over so little a time period. We've got about 176 billion that has occurred to date through 2021, another 155 that is remaining. To date, it's been pretty equally distributed between Texas and Louisiana based on our estimates, but as we move into the future, you're starting to see a shift of that more in Louisiana than it is in Texas. But do keep in mind that a lot of that is being driven by new LNG export capacity mostly. And so that gets you to that 62% in large part. And you can see this as we start decomposing those investments. Again, this is collectively for the region overall and we've kind of broken it out by major area, and the purple is the LNG exports. And so that creates, unique challenges in terms of figuring out, what is going to be the actual capital dollar amounts. Will these shift more as the uncertainty in gas markets change? How will these be impacted by global growth? Right now, these facilities that are operational are doing really, really well. But we're looking at, another 60 billion potentially in new investment as we move forward, and another 60 or so in chemical investments, which I think are important as well. So here's kind of the decomposition based on our estimates moving forward. Again, a lot of these are concentrated pretty heavily in Louisiana. Texas investment is somewhere around 57 billion. Louisiana investment somewhere around 125 billion. But you can see if you look between LNG and non-LNG, pretty heavy weighting, 86 billion located in the LNG category. So something to keep in mind. We're hopeful that a lot of this will get developed. It might shift a little bit as we go through future GCEOs, as we move that time horizon back. While we've had really, really high global prices, particularly those in Asia, it hasn't seemed to, at least in the near term, change some of those capacity outlooks, even though there are some that would suggest it might be there, particularly with some of the investment banks. But to date, it really hasn't moved the needle a lot. And if you look where futures prices are moving with gas, this might be a tightly closing window as well. So again, something to keep in mind. These can often be more speculative investments. One thing I'll say about the non-LNG investments is we're starting to see a number of these investments starting to become more dedicated into industrial decarbonization activities through green ammonia, green hydrogen, et cetera. And we're optimistic that as we do future GCEOs, something we'll watch, that this is going to be a category of new investments along with our traditional investments that are going to have to be watched. I mean, in large part, a lot of this is being driven by requirements globally and for the export-oriented side of the business. And what many of these countries have participation requirements with the Paris Agreement and other agreements, they're going to probably need to couple up any of their natural gas or other refined product demands, particularly with the LNG side, with some offsetting mitigation with carbon. And so the opportunity for carbon sequestration coupled with LNG here in South Louisiana may be that kind of combination that gives us some additional growth and could give us the competitive advantage for getting some of these LNG facility investments that are already here that don't include those potentials in their overall number. So again, something to think about as we move forward. Greg, I will turn it back over to you.
All right, thanks, David. So now what we're going to do is take all of that information and put it together in order to do our employment forecasts. So this is employment forecast for Louisiana upstream oil and gas sectors. And so this is sectors 211 and 213, which includes oil and gas extraction, as well as the services sector. And so as you can see, sort of a few trends here, and you look at the pre-2014, 2015 price crash, Louisiana was sort of oscillating around that 50,000 worker mark in that industry. And so you'd sort of, bump up and down a little bit, but would always kind of revert back to that 50,000 mark. And then you can see the really large drop here that happened with the oil price crash. And interestingly, when you look at the total Louisiana employment, what you see is that this oil price crash caused kind of a little business cycle contraction statewide, while the U.S. economy was still in an expansion. And you can see why we went from over 50,000 jobs to the trough almost 30,000 there. Then you see we started picking up a little bit there in the post-crash time period. And then, of course, COVID hit. And now at the bottom, we were around 24,000 jobs in February 2021. And so this, frankly, hasn't been a great story for the upstream industry. The upstream industry today is about half of what it was in terms of total employment in the pre-pandemic time period. So the sort of good news is the oil price is up. Natural gas prices are up. We're starting to see increased activity. I talked to one oilfield services company, for instance, Moncla Oilfield Services. They were telling us that they're having a hard time getting workers now. A lot of those workers left the industry and they're actually getting training rigs going again. So these are all kind of positive stories out there that lead us to believe that we'll have some increase in employment here over the next year or so. And so we're forecasting that we'll peak at about 29,000 jobs by Q2 2022, and then it'll kind of stay at that level thereafter. So as always, I like to look at the forecast from the prior years and see, what's changed our thinking. And so when we look at 2 years ago, the GCO, and this was before anyone knew that COVID was about to hit, we were kind of forecasting flat employment. The industry had stabilized. There was activity out there. We weren't anticipating much growth, but we were also looking to sort of sustain that employment level. Of course, then COVID hit, which is no one could have predicted. And last year, we were saying some of those jobs are going to come back. It's true that we've gained a few back, but it continued to drop a little bit longer than we thought. And so now what we're sort of reconverging to last year's forecast, if we will, over the next 6 months or so. If we look at Texas, so you see a similar but different story. With Texas, you really still see that up and down with the business cycle. And so you saw, of course, the pre-2015, you had that, that drop from over 300,000 workers to less than 200,000, the growth again, and then you see that COVID drop there. So Texas bottomed out at about 158,000 jobs in September of last year. They've gained about 24,000 jobs back since September of 2021. And they're forecasted to peak at 197,000 jobs by Q2 2022 and therefore be flat thereafter. I want to highlight something here that I think is instructive. And that is when you compare this to our to our production forecast, we're forecasting, or the Enverus broadcast model is forecasting record oil and natural gas production, both in the Gulf Coast region and in the United States. And this really highlights the technological advancements that's happened in these industries, that we just don't need the same number of workers to produce the same number of hydrocarbons. That's extremely important for being internationally competitive, but it's also important to think about when we think about our labor markets moving forward. Are we ever going to get back to that pre-2015 time period in terms of total employment, whether in Louisiana or Texas? And our forecasts are anticipating that that's not going to be the case. And so this, you can see the historical, and you see a similar trend there. So we're actually right now, we actually picked up a little bit slower than we thought in Texas, but the most recent month is almost right on the nose for our forecast from last year. And we're actually upgrading our forecast a little bit for Texas relative to what it was last year. Okay. One thing I want to point out here, and this is something that explicitly goes into the modeling infrastructure itself, but over time, we've had this declining share of upstream of employment in Louisiana. And that's really flattened out over these last 2 years. And so again, that's a bit of a good news, if you will, for Louisiana, that we're seeing more consistency in our employment levels relative to Texas. And I think one of the reasons for that is the growth in terms of the offshore production. I know the big story of the last decade has been shale, but offshore production has been extremely resilient. It's actually been increasing over time, and I think is less cyclical in terms of the business cycle. And so this just sort of highlights the importance of continuing that offshore activity for our regional economy, especially here in Louisiana. And when we look at the Dallas Federal Reserve, they have their business activity index. It's up, which is corroborating our forecast that we should see increases in employment. This doesn't explicitly go in, but we look at it to corroborate it, as well as the company outlook index here, which are both positive. Okay. So now let's look at employment forecast for the refining and chemicals. So as you can see, Louisiana, we lost about 1,600 jobs over the last year or so in that refining and chemical space. We're anticipating we'll gain about 1,300 of those jobs back by the end of 2022. 600 in 2023 and about 1,000 in 2024. So this model, how it works, it's a combination of, we've got a little bit of just bouncing back from COVID here as global demand starts to bounce back. And then the second part of that model is, of course, David's infrastructural numbers, which we go in and we estimate the number of jobs that will happen when different infrastructural investments are complete. And that's how we get that sort of cascading out into the future. So we should be back to our pre-pandemic jobs in refining and chemicals by the end of 2023 or so. When you look at our forecast, last year, really, we were sort of anticipating flat employment in these sectors. And we ended up losing those jobs, as we said. There's really two things to look back on. The first is when we were talking with companies, what they told us is that the core employees at those both refineries and chemical plants, they weren't really that impacted by COVID. It was really the contractors. And so we'll show that here in a minute, that certainly was the case. But we were sort of forecasting a little bit more resilience in that section. What we didn't, of course, forecast was Convent closing. That 700 jobs right there. Of course, there's positive outlook for that in terms of moving to a biofuels facility, but in terms of right now, and that's about half of the jobs that you see here. So again, but we're anticipating it's gonna come back over the next 2 years or so. We look at Texas, so you see a similar story here. They lost about 5,000 jobs in the refining and chemical space. We're forecasting that they're going to gain about 3,900 of these back by the end of 2022 and about 1,500 back by the end of 2023. And then out to 2024, as you saw in the David's infrastructural piece, Louisiana actually has a few more projects moving out further, especially in that LNG export space. Which is why you see the sort of slower growth in Texas relative to Louisiana in 2024. And you can see there's the forecast that we had, a very similar trend to Louisiana, but we've really downgraded that refining and chemical employment forecast over the last few years. Okay, so this is what I want to close with, is that this you see in Louisiana employment in the upstream oil and gas extraction and services versus refining and chemical manufacturing. And what you see that in Louisiana, we employ more people in that energy manufacturing side of the business than we do in the upstream part of the business. And we are forecasting that's going to continue into the future. This is very different than Texas, that still employs more worker in that upstream part of the business relative to the refining and chemicals. And so when we're thinking about the relative effects of those two sectors within Louisiana and Texas, they're very different for these reasons. Okay. So the other thing I want to highlight here is that when you look at the number of jobs in the overall economy, for every one job in upstream versus refining and chemicals, you actually see higher numbers for refining and chemicals, which again sort of increases the when we think about the relative importance of that energy manufacturing, which then again goes into this theme of export-oriented growth, which is spurring investment here in the Gulf Coast region, which is broadly supporting our labor markets here in Louisiana and Texas, of course, as well. So we've seen architectural engineering related services, that's bounced back since COVID. So that's good news in Louisiana. It's also bounced back in Texas. When we look at construction, which is again, both the contractors as well as the projects themselves, that has really not bounced back in Louisiana. And so while we don't do a construction forecast, as a lot of these projects that David was talking about get going, we hope to see an increase in construction expenditures. And this is really a real-time thing we look at. And then you can see that in Texas as well. So here we've got about 5 minutes left. So we're gonna, I'll let David finish with the conclusions. And while he's finishing with conclusions, if you have any questions, this is the time to put them in the Q&A. David, back to you.
Right. So again, thanks everybody for participating in this. In terms of conclusions, overall, I think the theme in this year's Gulf Coast Energy Outlook is that this pandemic-related recovery is occurring. It's continuing. It's expected to continue as we move through the forecast horizon. There are, some headwinds out there that we're going to have to think about from an economic perspective. You've got a pickup of COVID activities in Europe right now. Some other things that may wind up impacting global growth. Really dramatic changes in some other areas in Asia right now, and some of the trade issues that Greg talked about. But overall, if you start thinking about just the conventional wisdom, we're continuing to make good progress and should. From a production side, we're down about 1 million barrels a day, likely to grow over the forecast horizon on crude oil. I think the International Energy Agency is anticipating 60% of the growth next year is going to be filled in by U.S. production. So it'll be another million potentially that we make up. We're not going to make up the losses that we were originally anticipating from 2019 on, which is still probably another million where we could have been. But we should be getting back to those pre-pandemic levels pretty quickly, at least based on, again, the overall forecast that we have as well as others. Gas production continues to be pretty strong. And I think as long as you have globally high prices, you're going to wind up seeing some strength there, which is moving stuff at the margin. And as Greg talked about, the reserves this is not like, and a lot of people have asked me with regards to natural gas prices, particularly people who are out of region, Is this the new trend? Are we going to start seeing really high natural gas prices? What gives with all this? Well, this is kind of a cyclical, demand supply imbalance kind of thing going on right now. This is not like what we went through in the 2000s, where there was very real concerns about the resource base and our ability to meet our own natural gas requirements. And that's why we built a lot of those LNG facilities as import facilities to begin with back in that decade. So I don't see that as being a problem. That resource base is still there and will continue to be there. We may have some challenges getting people to work in those areas, as Greg talked about before, but it's still there. Prices, while they're up on a relative basis, futures markets themselves, which tend to be some of the better forecasts that you can get out there, because those are the ones that people are putting their money on, are moving towards those longer run averages over time. We're already seeing some corrections today on those numbers. I think you're going to see that as we move through the rest of the year. To me, the crude oil prices are going to be influenced in large part by global economic growth and in demand fundamentally, in terms of how those fundamentals change. And we're starting to see some softening, particularly with regards to Asia. It was the conventional wisdom that Chinese growth was anticipated to be 8 to 12% in any given year. Now those numbers are challenged to be in the 6% a year range. And that, I think, changes the outlook on demand fundamentally for, a big growing part of the global economy. And that I think that's something to keep in mind as we move forward. And those are going to influence those prices, not only for crude oil, but for natural gas as well. For refineries, we've had a lot of uncertainty. The two closures have been certainly something that have been on the downside for us. There could be some other issues out there waiting and looming, but certainly with something that we need to watch out for and be concerned about. I think the assumptions that these facilities can be here and are built here and aren't going anywhere gets considerably undermined by some of these decisions that we see. And so it's important to continue to have a very positive and constructive investment environment in Louisiana if we want, and on the Gulf Coast period, if we want to keep some of these investments. Again, as I mentioned before, exports are going to be driven by Asian growth. Those are probably slowing down, but look, we're not looking at a global economic recession, and we're certainly not looking at any contractions. And as Greg said, I think the thing that we have to watch out for over the next year is, what the Biden administration tries to do with these trade negotiations. It hasn't been on their front burner per se, but it could become, after we get through the Build Back Better issues, the debt extension, and all the other things that we'll be fighting at the end of the year. This could be a new topic that gets picked up in the next year. For power, again, I think we still got some opportunities for growth. Capacity growth and renewable, I think, is a foregone conclusion. I think the thing to think about is for this region, and I think this came up yesterday at the Public Service Commission meeting, is what are we going to do as a region on infrastructure investments relative to resiliency in the energy transition. Lastly, to put a fine point on it, 2022 is going to be a really political year. These are the midterm elections. I think you could see a swing as significant this year as you did going back to the 90s with the Contract of America, or in 2010 after in the first term of the Obama administration, where the House swung by as much as 50 seats. Energy is going to be a big part of that discussion. You don't have to be a big political analyst to figure out the discussions on gasoline prices and inflation right now and what those do to household budgets. The Build Back Better plan has opportunities for creating investment. The infrastructure plan itself does too, particularly in the power sector, but there's also going to be some hammers in there as well, particularly for oil and gas and the fossil fuel industry, in terms of increased taxes and increased fees and assessments. If we get into these carbon fees and tariffs, not only in Europe, but in the United States as well, those could have disruptive impacts as well. So with that, again, I want to thank everybody for participating today. This was really amazing. I was looking at the numbers, and they were really significant and high, and that's great. It's a good affirmation for us. Again, I want to thank our sponsors who provided all the support for us this last year, and all the people who spoke to Greg and I through the years we were formulating this. And with that, Greg, why don't we turn it open for some questions?
Yeah, sure. So we've got a few questions here. So the first is if there's a rapid transition to renewable energy, do you see significant changes to these forecasts? And I'll say that, we do have built into the forecast very aggressive growth for renewable energy capacity, both for solar and for wind. Here in Louisiana, of course, that's that solar capacity. We have 6,000 megawatts of capacity in the interconnection queue in Louisiana alone. David, I think, quoted 10,000 megawatts of capacity in MISO South. And so, yes, I think that definitely is going to be something that we look at very closely in terms of our forecast. David, do you have any comment on that?
Yeah, I'll say, and again, this was a theme we had in the greenhouse gas inventory and the analysis. And if we're going to solve our Louisiana and the Gulf Coast and the Texas Gulf Coast, our big challenges are going to be in industrial decarbonization. And one of the many strategies, there's no one silver bullet, but one of those many strategies is going to wind up being electrification in some of these industrial applications. So in the near term, you could actually see some electricity growth, and a lot of renewables are in that electricity space. So, these are kind of baked into that. I think that is kind of the conventional wisdom as we move forward, that you're going to see that. And you don't, what we haven't talked about in all of this is electric vehicles and changes in the transportation, et cetera. So, the opportunities for renewables to fit in there and the growth to fit that in, it's not going to be, in the near term, it could not be as cannibalizing as you might think with regards to natural gas. But at some point that does become an issue.
All right, so the next comment is, do you have any comments about the fungibility of renewable sources relative to oil and gas? Will renewables provide enough energy to fuel society? You want to take this one too, David?
Look, I don't think anybody practically is looking at that right now in the near term. I know there's a lot of discussion and noise on one side, but again, like I mentioned before, there's still a lot of growth for renewables, a lot of investment opportunity for us in Louisiana. You start thinking 10 gigawatts plus just in the state alone in solar. There's still some opportunities. It's not going to come without challenges. There are a lot of integration costs that usually don't get factored into some of these discussions. A lot of operational challenges. And again, there was a big discussion at the Public Service Commission. There were some discussions and articles in the paper that recently about our continued participation in MISO, in this regional transmission organization, in large part due to the sharing of costs associated with integrating these renewables. So again, it's an important issue. It's an important question. I don't know that we've hit that tipping point yet with renewables. But it is something to think about. But the bottom line is, no, we're not going to, I think most reasonable people would expect that we're going to have oil and gas into the near future, and they're just going to be for many applications, even in the industrial space, just very few substitutes, particularly as we look into the next 5 to 10 years.
All right, the next question is from Bill at Bessie and asks, can we touch on the impact past and forecasted of the impact past and forecasted of the 2015 export ban a little bit more? And yeah, I can talk about this a little bit. So, back when the export ban was being lifted, we actually released a white paper here at the center that kind of talked about the risks and opportunities of that for Louisiana. And, one of the things that I had pointed out at the time, and that was later published in an academic paper, was that, you had these price differences in oil here in like the West Texas Intermediate versus Brent. And there was this huge dispersion between them. And this was at the time when all the shale oil was coming online. And there was a story out there, and a lot of the people testifying to Congress were saying, hey, this is because that export ban was there. We actually went back and did a lot of empirical work with that, myself and a colleague who at the time was at Rice and now is at UC Davis. And we actually didn't find evidence of that. In fact, what we found evidence is that it was those midstream constraints getting that oil down to the Gulf Coast. It was driving those price differences. So it's kind of the cost of that export ban, I think, was being set, that was being pitched out there, probably wasn't really there to the extent that some people had thought. On the other end was this protectionist policy for the refineries. And so now that you've got the export ban lifted, you make this decision, okay, I've got this oil production here. I can choose to either refine it here in the United States and then export those refined products, or I can choose to just export those refined products. And so the Phillips 66 Alliance transitioning to a terminal facility is a really good example of that. And so it's, of course, it's not possible to know the counterfactual, what the decision would have been. But we definitely think that crude oil export ban's lifting, or at least I think, definitely plays into that decision. So yeah, I mean, I think it's important when we think about the refining industry here in the Gulf Coast. All right, we got one more renewable question. David, do you know where people can find more information on tax credits for renewable projects?
There are a couple of places. I think there's a database that the National Renewable Energy Labs, NREL, has that lists both state and federal tax credits for renewable energy. A lot of the trade associations through the American Wind Association or the Solar Energy Industries Association, SEIA, has that kind of information too.
All right, we got one more question. This will be the last one. Looking at cyclical trends in Louisiana with respect to employment and economic performance over the years, can you share some strategies in place to reduce the potential vulnerability of the economy? I'm sure David and I could talk about this over beers for a long time. We both have lots of ideas here. You know, one of the ideas that I've had in the past and and that we've looked into is taking, you know, a very small share of severance tax revenues that the state receives and sort of putting that into a long-term trust fund that would grow and we could have the interest off of it. And so that would be a good example of a strategy that the state could do that could, you know, make sure that that oil and gas production that we have today is invested into the future and is able to sort of, you know, be a smoothing in our business cycle in terms of the government revenues, as opposed to right now where it's one of those more volatile pieces of it. So I guess that's one example. David, do you have any other examples you'd like to think about?
No, I think implicit in that with trust funds and things of that nature are, you know, what are you going to spend that money on? And you know, I think the economics literature is pretty replete with, you know, the importance of education and workforce development in terms of stimulating and motivating economic growth. And I think as a big overarching challenge, the better off our workforce is educated, as well as not only just in traditional education forms, K through 12, and college level education, but vocational and skill levels, which are equally, if not even more important in some industries. You know, those are the things that we're going to have to continue to be important about making investments in.
Well, thank everyone so much. We promised to try to do an under hour. We're 7 minutes over, but we appreciate everyone's time, everyone's questions. And do you have any closing comments, David?
I don't. Just thank you everyone for participating. This is always a great opportunity for us, and we love the affirmation that we're getting by having all this participation. And if there's anything else we can do or follow up, please let us know.
Thanks again. Have a good one.